Hello, everyone. This is Steve Gorin, and thank you for attending today's webinar, Business Owner Compensation versus Distribution, Modifying Trusts or Their Investments in Light of Proposed Tax Changes. Before we begin, we want to cover a few housekeeping items. If you have any questions during the webcast, you can submit them through the Q&A widget at the bottom of your screen. We will try to answer these during the webcast, but if a fuller answer is needed, or we run out of time, it will be answered later via email. A copy of today's slides, as well as other reference materials, are available in the resource widget. You can find answers to some common technical issues located in the help widget at the bottom of your screen. This webinar is CLE accredited in California and Illinois for 1.5 general credit, in Missouri for 1.8 general credit, 1.5 general credit in Texas, which is pending, 1.8 general credit in New York, and 1.8 credit in New Jersey, which is pending. We award CLE based on attendance for the entire 90 minutes. Due to changes in jurisdictional requirements, you will notice that we are no longer using the automated pop-up attendance checks. As required, we will display secret words in 3 multiple-choice polls during the webinar. You will be required to select today's secret word from a multiple-choice list. Please respond to these 3 polls to demonstrate your continued engagement and to earn your full CLE credit. The certification icon located at the bottom of the screen will only tell you if you have met our criteria for awarding CLE. It does not include the certificate of attendance. Once we have verified your attendance, your certificate will be emailed to you later. This webinar is being recorded and will be available within 24 hours. You can access it from our website, www.thompsoncoburn.com. All attendees will also receive a link to the recording. Please do not hesitate to share it with other professionals who may find it useful. And of course, if certain parts stand out, you can fast forward the recording to those parts. We value your opinions and appreciate your participation in the webinar. So now to get down to the business of learning here. So we're going to talk about owner compensation versus distribution. So this is purely an income tax planning for business owners topic. The next topic is modifying trusts or their investments in light of proposed income tax changes. And in particular, I'm thinking about Biden's, what they call the Green Book. And there's going to be really a couple of different sections on this. We're going to talk about terminating trusts now or extending trusts now. And we'll also talk about separately about deferring or avoiding income tax due to changes in the rates. Now, owner compensation versus distribution. So first I want to, so we're on slide 3 now, and just look at the parenthetical there. That's Roman numeral 2A1B Romanet 2, and those are references to my business structuring materials, which is now over 3,000 pages long. So you have my newsletter that's attached, and of course my newsletter has 3 different articles, and this of course parallels those 3 different articles in the newsletter. And the articles in the newsletter has cross references to portions of my 3,000 page PDF. So those are references to the 3,000 page PDF. And anybody who, if you have any difficulty with the links, you can always take the slides and copy that cross-reference from the slides, and then do a find search in the big PDF and paste it in there. Okay. So strategically, and I'm talking about before or after any of these big tax changes that are being proposed. So after paying tax or making tax distributions to owners, most businesses will reinvest part or all of their income and distribute the rest. Some businesses will just distribute enough to pay taxes. Other people will distribute out a little as kind of what they call a bonus distribution, and others will pay out the whole thing. Now, for income that is being distributed, pass-through taxation tends to be the best. So we like to be a partnership or an S corporation where instead of the entity paying the income tax, the entity gives the owners a K-1, and the K-1 reports the owner's share of the entity's income. And the owners have to report that income regardless of how much they actually receive from the entity. So if you have an S corporation or partnership and you're distributing all of your income, that is generally going to be the most tax efficient thing. Now, for income that is reinvested, C corporation taxation tends to be the best in the short run, not the long run, just in the short run. And that's because C corporations are taxed at lower rates than individuals are. So what happens is if the C corporation reinvests its earnings, you just have the lower C corporation level of tax. If the C corporation distributes its earnings, then the corporation pays tax on the earnings and the owners pay tax on the distributions. So you have two layers of tax going on there. So one layer of tax inside the C corporation in the short run is cheaper. But if you are distributing it all out, then one layer of tax through the pass-through entity, the S corporation or partnership, is less expensive than paying the double taxation, the corporate level tax and the dividend tax. So again, those are all kind of short-term annual income tax. And I've done other webinars where we've gone through, we spend about 20, 30 minutes and go through the income tax dynamics of long-term and short-term distributions from the various business entities and taxation on the sale. So if anybody wants to look at those, I'm happy to email you which of my prior webinars has that. So you can just email me if you have a question about that. Okay, so on slide 4, I just want to make you aware of some resources that I have, and then we're going to go through, after I show you the resources, and do some more substantive talk. So the first bullet point, taxes imposed on C corporations, that's where I go through this math that talks about the C corporation annual income taxation, and I also talk about the taxation of distributions. And then that second bullet point, that goes through and explains various ways to look at the tax rates that apply when you have an S corporation, partnership, or sole proprietorship. And by partnership or sole proprietorship, I also include LLCs that have multiple owners taxed as partnerships, or that have one owner and it would be taxed as a sole proprietorship. Then I have another whole set of discussion on strategic considerations, including exit strategies. And some of the theme in that part of my materials talks about, well, first of all, if you are selling your C corporation, you have generally a double taxation because you have the capital gain tax on the sale of the stock, as well as having been taxed on the earnings inside the corporation. So in the long run, there will be the two layers of tax in most cases. Exception might be there's an exclusion for certain small business stock, and also if the owner holds the stock till they die, then you can get a basis step up, if that doesn't get repealed. And I also talk about the recommended long-term structure for pass-throughs. And a lot of people really like to be S corporations, and accountants will suggest to clients to be S corporations because then they can avoid self-employment tax on their earnings. So in addition to income tax, there's what we call FICA tax, which is 1.45% hospital insurance Medicare tax, and another 6.2% old age survivors and disability insurance. That's your Social Security benefits. So that adds up to 7.65% employer, 7.65% employee, or 15.3% if you're self-employed. And if you're taxed as a partnership, then generally you'll have the self-employment tax on all of your earnings. And by the way, that self-employment tax, it caps out at around, I think it's about $140,000 plus or minus here. My materials have the actual number. That caps out at there, and then it goes at 2.9% for earnings above that, and then once you get above 250,000, it's 3.8%. But so accountants are trying to help their clients save the self-employment tax, the 15.3 tax on their earnings, so they recommend being an S corporation instead of a general partnership or an LLC that's taxed like a general partnership. The problem with S corporations is that when a person sells their stock or a person dies and the stock gets a new basis, that new basis doesn't carry through to the S corporation's assets. So while there may be a step up in the basis of their ownership of the entity, it doesn't help with the inside of the entity, the assets of the basis that the entity owns. Whereas if you have an entity tax as a partnership, then you can carry through that basis step up and apply it to the assets inside the entity. And for that reason, my preferred structure tends to be a limited partnership with an S corporation as a general partner for like about 1%, and everybody else being limited partners for 99%. So for 99% of it, you're going to have this basis step up passing through, but limited partners don't pay self-employment tax on their distributive share of income, their K1 income that is just a distributive share. So that's the type of entity which I tend to recommend for long-term planning. Maybe start off as an LLC and move into the limited partnership structure as you get more sophisticated. So on slide 5, this hybrid structure, what you might want to do, and if you don't want to be a pure pass-through because you're reinvesting a lot of your earnings, what you might want to do is be a limited partnership with a C corporation being the general partner and having individual limited partners. So what happens is when the limited partnership makes its distributions, so it would distribute all of its earnings. The individual limited partners would take those distributions and they pay their taxes, and then they keep the rest as the intended cash flow that goes to them. The C corporation would pay its taxes, and then the C corporation could loan that money, whatever's left over, back to the company. So that's what lets you reinvest. So the idea here is that we can get the reinvestment tax at the low C corporation rates, and we can get the pass-through tax only once as it goes to the individual limited partners. Now, what portion are you going to be distributing each year? What part are you going to be reinvesting? I mean, the answer is we don't really know. We might know right now what we think the ideal thing is, but things change over time, and flexibility is needed. So if you really want to try to use this tactic of having C corporation and reinvesting those earnings, there's no way to get it perfect because every year your circumstances are going to change. When in doubt, what you might want to do is to err in favor of having more income allocated to C corporation so that you can have it set up for the reinvestment. And then the C corporation might pay compensation to the owners to get a deduction so that when the money passes to the owners, there's no corporate level tax because you're deducting this compensation paid to the owners, and then the owners just get their single layer of tax. So what you're trying to do is you're trying to replicate this partnership single layer of tax, but do it with the part that was running through the C corporation. So that's the way that a lot of people, I wouldn't say a lot of people just do a C corp and then they figure out how much they want to distribute and how much they want to reinvest, and then they just pay the compensation out. Not too many people really do this hybrid. The issue is that, let's face it, if you're trying to get this money out to save taxes, used as compensation, then it's really not reasonable necessary compensation, and the IRS will say, hey, that money was not really compensation, that was just a disguised distribution, and I'm not going to let you deduct it. You can have the double taxation, the C corporation taxation and the dividend level of tax. So that brings us to our hot topic of a current case. So Aspro Inc. versus Commissioner, Tax Court Memo. And I'm not going to say there's anything groundbreaking about this case, but it does show what you would want to try to avoid doing when you're making trying to adjust this compensation that goes out to the owners who are working in the business. So in Aspro, the tax court was presented. Basically they said management fees are things that are supposed to be provided purely for services. If it's not paid purely for services, it's not a management fee and it's not deductible. And each year, the corporation did not make any distributions to its shareholders, so no dividends, but it paid management fees. So, that's a red flag right offhand. Is that if you're trying to pay no dividends, then you're not doing something which is going to be giving a return to the owners. So that is a concern about the C corporations that try to do things exclusively through management fees. Now, in this case, there were a couple of corporations and an individual who owned. And the two large shareholders always got equal amounts. Isn't that funny how the services they provided lined up exactly the same in terms of the value of the services they did? And that happened to be proportionate to their ownership. And the management fees to the shareholders, so the amounts that were paid to the corporations as independent contractors and the amounts that were paid to the individual shareholder were roughly corresponded to their percentage ownership interest. So that is a red flag. Again, having the fees correspond to your ownership makes it look more like a payment to you as an owner, not a payment to you as a service provider. Now let's go on to slide 8. The management fees were paid as lump sums at the end of the year, not throughout the year as services were performed. And you can see the bad things here listed in these bullet points. But the bottom line is suppose client comes in and they say, okay, here's my projected taxable income. How much should I pay as fees to myself? And it's going to be enough fee. We're going to pay you enough fees to zero out your income. And we're only determining at the end of the year because that's when you know what your profit is from the year. We don't want to pay out too much as compensation because then that would give you net operating loss. And by the way, when you look at what the 2017 tax reform did, it said that if you get a net operating loss for the year and you go to carry it forward, you can't offset that against your taxable income for the future year, not against 100% of your taxable income. So there's an 80% limitation. Now, they suspended some of that in connection with the COVID stuff. Is COVID relief is going on. But the bottom line is the net operating loss carry forward is not the most efficient way to do things. So you'd want to figure out what your income might be, and then zero it out this way. That's kind of some of the thought process behind what I was saying before about titrating it. But again, if you're paying for services truly, I mean, we get paid when we render our services to our clients. Hopefully they're going to pay their bills on time, but we bill them when we do our services, and then we collect it. We don't set some arbitrary year-end time to do it. We might be trying to get our fees collected by year-end for the services we did, but normally you're going to be billing for your services you provide them. And employees, normally they get paid their paychecks, whether it's weekly or monthly or whatever it is, they get paid their salary. You don't wait and pay the whole thing at the end of the year. That just doesn't look right. At least, again, this is how I'm basically describing, not necessarily my opinion, but what the tax court is kind of looking at this as, what the IRS is looking at this as. And that's the concern. So again, you had that timing being horrible, and you have the lack of dividends and the lack of total return that an independent investor would require. And this last bullet point is really the one that courts have started to focus on in the last 10 or 20 years. There's one thing you can do certainly is you can get your compensation expert out there and say how much your compensation was worth. But the other question is, look, as an investor, I want a return on my investment. As an investor, am I going to be satisfied with zero return? Well, maybe I will be if I'm investing for the long run and I really want to reinvest all the earnings. But if my executives are taking out all the earnings and I'm getting nothing, that doesn't seem like too good a deal for the independent investor. That's the theory. Again, I'm not necessarily saying what my view is. I'm just saying that's the theory that they go by. And so the courts will say, well, what would an independent investor require? And if you pay dividends on what an independent investor would require, then that goes a long way towards saying, okay, the owners got their share, so this is not intended to compensate them as owners. They got their share as owners through the dividends, and then when the compensation got paid, well, once the owners got treated fairly, you can do what you want with the employees. So that's the theory behind that. This particular case was looking at more so the haphazard way of determining management fees, having no criteria listed for awarding the fees. Just kind of end of the year, accountants figure out what's going to zero out the profits, and boom, you got magically down to your zero profits, and you've gotten all your money out to your owners. So that was really the focus on the case. But the court did at the end throw in these ideas, the lack of dividends and lack of total returns, and those two items tend to be focused on more so than the first couple items. So kind of the bottom line best practice is figure out what the services are worth, pay them out over time. And service providers do tend to get bonuses at the end of the year when you see how things are going and how much money you have available. So pay throughout the year some reasonable amount, and if you want to pay a bonus, then go ahead and pay a bonus, but set it according to a bonus plan. What are your criteria for awarding bonuses? What is a reasonable bonus? So they just really wanted to see a lot more to back up this compensation, and bottom line is they didn't. So you'll see in my materials I have some quotes directly from the case. So be careful you don't do what they did. So I had a couple comments in the chat, in the questions and answers. Surely in many circumstances with several shareholders who are active in the business, they might be contributing services roughly in proportion to their ownership interests. And I do agree with that statement, but that is roughly in proportion, not necessarily exactly in proportion, and people's relative contributions and the value of those contributions do vary from year to year. So yes, the owners need to get along, but you do need to recognize the merit, and that the merit can change from year to year. Okay, going on to the next part, S corporation distributions recharacterized as compensation from the S corporation. So again, as I mentioned, S corporations will save the FICA, and a lot of times owners need to get advice on how much is my compensation and how much is this my distribution to me as an owner. Because the distribution to me as an owner is not subject to FICA, so that 15.3% or 2.9 or 3.8 that I mentioned earlier. So how much of it is subject to that FICA that the employer and employee each pay, and how much of it is just a regular distribution. So some people get greedy and they just make distributions and they don't pay their owners who are working in the business any compensation because they want to try to avoid that FICA. And in this particular case, this Ward versus Commissioner, it is more of an outlier case, but it just drives home a point. Here, there was no employment taxes paid on any of the payments that went to the shareholder employee, and anytime you have a corporation, and you're going to have officers, and the officers are working in the business, that is wages, and that's just black letter law, and in this particular case, they were greedy. They didn't pay any compensation. They said the whole thing was distributions. And then they characterized, for example, in 2013, they characterized this as wages or draws on a personal return rather than W-2 income. And of course, that didn't fly. The shareholder argued that she received non-taxable distributions but didn't prove basis, so that didn't fly. Bottom line is an officer is always an employee, and the corporation argued that some of the payments were self-employment income to the officer. Maybe I paid you some salary, but you get some self-employment income. But the problem is, all the work was for work as an officer, and basically the company didn't put forth any proof saying that there was some work done as an independent contractor. It was all done as an officer, and everything paid to an officer is wages. Now, of course, one way you can control this issue is just reinvest the earnings, and then it can't be counted as wages to the company, to the employee, because the employee shareholder, because they didn't receive anything. So reinvesting earnings is an important thing, but of course you need to make tax distributions, and to take zero compensation for your work, it's a tough thing to sell. Okay, on this next slide, we have another. It's really unrelated to those other issues. You might have a business and it's doing business as a partnership. Again, it's an LLC, taxed as a partnership typically, is what we're looking at here. And then you have your key employees. You're paying them on a W-2, and you decide, hey, let's be more entrepreneurial with the key employees. Let's give them a profits interest in the company so that they can get rewarded for the entrepreneurial gains based from their services. So you give them a little profits interest. So what happens is that once they become a partner by getting that profits interest, everything they get paid is characterized as a partnership. So instead of getting a W-2, they don't get their compensation on the W-2. The compensation is what's called guaranteed payments, and it appears on their K-1 at the end of the year, and is taxed based on the guaranteed payment that was accrued, not on the cash they actually necessarily received, if they might have received it after year end. So the guaranteed payment, a lot of people they don't like that. People like to get their withholding. They like you can do some nice little games too. If you're an employee, you do withholding at the end of the year. It can count as estimated tax payments throughout the whole year. So that's another fun thing that accountants like to do. But a lot of times people who get this profits interest, they really don't want to be all in as an employee, and so people will do gyrations to try to resist this. So one thing they'll do is they will have their profits interest issued to the S corporation. So the employee sets up their own S corporation to get the profits interest, but they still get paid their compensation through their regular work through the LLC. Now, the IRS will then say, okay, well, what about what came through this S corp? So first of all, you got the K-1 income coming through the S corp, and then of course the employee is going to take the position that that's not subject to the self-employment tax. The S corp is a blocker, and it's just a distributive share of income. The only problem is that LLC is going to be making tax distributions. The LLC is going to make tax distributions to the S corp, and most likely that employee who owns the S corp is going to want to use those tax distributions to pay the tax on the K-1 income. Now, all of a sudden, you've got cash coming out from that S corp to the shareholder. And yes, this was declared, as a tax distribution from the company, and that was the whole purpose, et cetera. But the bottom line is that this employee is earning the money through their work. It's going to the S corp, but they're an officer of the S corp. Got to have some officer, and all of that money is coming through to the S corp because of their work. It's totally because of the work that they got that profits interest. So when the S corp makes distributions to them, the IRS might argue that all those distributions were really wages and not an owner distribution. Now, I'm not saying the IRS is going to win. I'm just saying that you face this issue that you have to deal with. So now think about it. If the IRS does succeed in calling it wages, remember how I mentioned that the FICA is paid up to like about $140,000 or so of income every year of wages. So you may have an employee who's getting paid more than that amount through the partnership already, and they're kind of capped out. And if they had just simply taken their profits interest as a K-1 directly issued to them, they're already capped out at their FICA. This profits interest isn't going to cause them to have extra FICA below that taxable wage base where it's a 15.3% rate. But now, if they have an S corp, and the S corp is making payments to them, and the IRS characterizes those as wages, and if the IRS wins on that, now you've got the whole new running up of that $140,000 or whatever it is taxable wage base, and so you may be paying double on that taxable wage base. The S corporation would pay the employer's share of FICA and would never get that back. And that is an extra expense because if there had been a K-1, that an employer's share of FICA for that up to the taxable wage base would never have been paid. The self-employment tax would have been taxing only 1.45% as an employer, as opposed to 7.65% up to the taxable wage base. So if you if they do try to do this blocker, I really think of it as something that has potential to really come back and bite you. Now, some people are insistent, so they do what they want, and a lot of times the business's lawyers, they're just issuing, there's no skin off the back of the business itself, of the LLC, in my example, for this extra FICA being paid. It's really the tax advisor for that employee who's causing the problem by avoiding the S corp, and they're the ones who the employee is the one who's paying it. So tax advisors to businesses don't necessarily think all this through because it doesn't hurt the LLC itself. It's the employees, tax advisors, who are causing this problem. So I just wanted to alert you to that, because if you are advising a business and they are asking the client to go ahead and issue this profits interest to the S corp, you might suggest that their tax advisors, the employees' tax advisors, really think it through a little bit more to think about these issues. Okay, so the first two bullet points in slide 15 I've already gone through. The third one, I do have a section of my materials that goes over what happens. Some people are like, well, no harm, no foul. If you count partner compensation on the W-2 instead of guaranteed payment, we'll do the W-2 anyway. And there are some issues with it, and so I wanted to alert you to those. And there's also the question about who performed the services, and I'm not getting back. I'm kind of getting rid of moving away from, on this last bullet point, I'm moving away from this other discussion about the K1 going to the S corp that the employee sets up, and thinking more about just the general idea that if you do have some money coming into a business and it goes to an employee, who really earned that money, and who should be taxed on it. And I just have a section that goes on those issues that has tripped people up in the past. All right, slide 16, just another compensation issue is in this particular letter ruling, there was an agreement to sell S Corporation stock to a service provider, and if certain triggers occurred, and those triggers did not occur, and instead, when they were going to go ahead and maybe sell the company or whatever it was they were going to do, what they did is they cashed out the employee just with a bonus. They never actually issued the stock. They just said, here's the bargain you would have gotten to buy it if you bought that stock at that price. Here's the bargain you would have gotten. We're just going to pay it to you in cash. And because the service provider never got the stock, you never had to worry about any of the rules on what would have happened with that person being an owner of the S Corp. There's another case on slide 17, which was a really silly situation. I'm not going to get into all the details. This guy formed a nonprofit corporation, and then he claimed that he could take the losses because it was an S Corp. And the court said, no, it's not an S Corp, it's a nonprofit. You can't have an owner. And so I think this is kind of an outlier case, but the case does review the law on who is a shareholder whose consent would be required to make an S election. So whenever you're doing S elections, you're just kind of like, well, do I count this person as a shareholder or not? You can just look at this case for a review of the law. Not for the case's holding itself, but just for a review of the law so you can see what are some relevant issues. First polling question. Okay, so the first polling question, today's first secret word is urban. So please correct the secret word from the drop-down selections below. Again, the secret word is urban, and please correct the secret word from the drop-down selections below. Okay, now we're going to move on to the next slide. So the next slide is talking about shareholder split dollar and S corporation. I'm not going to get into all the details of what a split dollar life insurance agreement is. There's been some activity in the tax court and the Court of Appeals basically, there's some regulations that say that whenever you have a split dollar life insurance agreement, that any benefit from that is a distribution to the shareholders, and the Sixth Circuit takes that regulation quite literally, and the tax court unanimously said that if it's a compensatory split dollar agreement, then it's not a distribution, and so that regulation doesn't apply. So there's a fight going on between the tax court and potentially with the Sixth Circuit. So I just wanted to let you know about that development in that particular case. Miscellaneous issues and equity incentives. So there's some IRS guidance on FICA and income tax withholding of stock awards. You can read that for yourselves. Also, there's a provision relating to basically intended to go toward carried interest, and you had to hold those for 3 years in order to get long-term capital gain treatment. If you're described within that code provision, the proposed regulations when they came out said that if you transfer these carried interests by gift, then that would trigger income taxation. The final regulations that came out said, no, you don't have to worry about that. So I'm not going to go into details on those. Those are for your reading. I'm going to go on to some more strategic issues. So tax effects of modifying trusts. So this is what I was talking about, Biden's Green Book. And it proposes taxes on distributions from trusts after December 31st, 2021 as part of this capital gain recognition regime. Now, we don't know whether this is going to be enacted. There's no legislative language drafted yet that I'm aware of. So it's premature to take action. But at the same time, I don't know when this is going to occur, but I want you to know about it in case you do need to take action. Whether you discuss it with your clients now or later is up to you. I mean, you can discuss it with your clients now that here's a potential threat, and they can think about the idea of terminating trusts and just kind of noodle around in their brain. I mean, that's one approach. Another approach is just to wait to tell them, or you can just tell them and actually start working on what would it be like to terminate that trust. Whether this goes through or not, I don't know. And taking time to really map out a strategy might be very premature and might be a waste of money. But this is my last article, last lecture on this for you in terms of my quarterly until October, and something might be passed before then. And I just want you to be prepared for this. So there are two different tactics you can take. One is to terminate a trust before the tax occurs. So terminate it in 2021, then you don't have a tax on the distribution from the trust. And by the way, what I mean by the capital gain recognition regime, basically they would say that whatever the trust has distributed is a deemed sale. So no more tax-free distributions in kind is the idea. So one tactic is, of course, consider terminating trust now so that you don't have a termination later, and then you can avoid that tax. You can do your distributions in kind tax-free now instead of waiting later. And it could just be a matter of, if you have a trust for multiple beneficiaries, split that up into separate trusts for each beneficiary. So it's not like you're putting the money in their little hands where they shouldn't have it. It's not like you're doing that. You're still keeping it in trust, but you split up the main trust. So you've kind of gone your separate ways among the different beneficiaries, kind of untangle them, so you don't have to have a tax on untangling them later. So another issue might be, well, what if now you're planning that there's going to be this distribution down the road, it needs to stay as a single trust now, or maybe you're even not even having the trust created yet, but you're thinking about creating it. So before the trust terminates, you may say, hey, this trust would be terminating in 10 years. I do want to keep it together. I don't want to have separate shares that are commingled, because that's another option. You could just have separate trusts and commingle those separate trusts. That's doable too. But you might want to say, hey, we're going to have separate shares. Instead of distributing the trust, we're just going to have separately managed shares. So we're going to talk about what that's going to look like too. Okay. Now, if you're going to terminate the trust, there's a ton of prior authority audits. A lot of them tend to be letter rulings. My fourth quarter 2019 newsletter has an article on it, and my January 28, 2020 TCLE has an oral presentation of it. I'm going to do a really brief summary below. I'm not going to do justice to the whole topic because you need to look at those resources for the in-depth exploration. But here on slide 23 is my list of resources that kind of goes through the various topics. Slide 23 and slide 24 shows those different provisions that you can go into. Kind of the bottom line is, if you just make a distribution in kind and it's authorized by the agreement, there's no particular tax consequences to that, at least not until that proposal from Biden takes effect, if it ever gets passed. So it's okay to do that. On the other hand, what if you have a mandatory income interest and you're giving that up? I mean, that is a defined legal right that you're giving up. And if you give up your mandatory income interest, that would be a sale or exchange. Now, what if you have distributions for health, education, maintenance, and support, and every year you distribute X dollars? Well, arguably, that interest in the trust is worth the present value of those future distributions of X dollars per year. So again, you kind of have a defined interest, and if you give that up on the trust termination, then arguably there's a sale or exchange. On the other hand, what if the trust says that the trustee can distribute among all of my descendants for their welfare, and then, and in fact, can distribute to or for the benefit of all of my descendants for their welfare, and then the trustee goes and divides it up, which could include a termination. Well, that was all authorized as standard distributions. There should not be any income tax consequences to that. So I wouldn't say there's any particular bright lines on it. It's more of a continuum, but my materials do explore that a little bit to give you just some ideas of some thoughts you might want to use when you apply this. I haven't really seen any particular cases that really go through and analyze this as a continuum and say, here's a continuum, here's the bright line, here's where it stops and starts. So you're still on your own to go through a lot of this analysis. There was a CCA, Chief Counsel advice in 2021, where the remaindermen agreed to have the trustee distribute the entire trust to a surviving spouse. It was a Q-tip trust, so mandatory income to the surviving spouse. She was the only beneficiary during life, and then at death, it would pass to the children. And the children said, you know what, surviving spouse, you can have everything. We're going to kill the trust, you get everything. And the surviving spouse then said, okay, I'm going to take some of the money I got from this, and I'm going to create trust for the remaindermen and allocate GST exemption, so it's outside the estate tax system forever and ever. The examiner said the remaindermen made a gift when they let the surviving spouse receive the entire trust. And the remaindermen argued that they received the GST exempt trust in exchange for their interest. so they really didn't make a gift. But wait a minute. Think about that for a moment. The remainder men gave money to the surviving spouse that she then used to put into the trust for them. So that was the exchange. If that really is the case, it was the remainder men's money that was used to fund the trust for them, and it would be included in their estate. Code section 2036. So the remainder men made this argument that there was no gift because she created a trust for them, but really they didn't want that result. That was just their argument to try to avoid the gift tax. So you really don't want to make that argument when you're terminating the trust. So I really do like that the IRS did say that that was a gift from them to her, because then that let her separately make a gift to them. Now, there's still some step transaction idea potentially there, but, the CCA is taking this position. If that's what the IRS is going to say, no step transaction, then great. What really concerns me about the CCA is the surviving spouse had a testamentary power of appointment in favor of the grantor's descendants. So the children were the takers in default. If there was no exercise of the power of appointment, yes, they would get the remainder. And as remainder men, they did have the rights to information about the trust. So they did have some legal standing. But there was no assurance whatsoever that she wouldn't have cut them out and sent all the money to the grandkids and bypassed those nasty kids. So the IRS made that argument. Now, if I were arguing this case with the IRS, I would say, hey, the chosen remainder interest did not have an ascertainable value susceptible of taxation. They had no assurance whatsoever that they were going to get that remainder. So I would value that as zero. That would be the argument that I would make. The CCA did not indicate that the children had made that any such assertion in their defense. So I don't know what's going on. I mean, did the children's lawyers just drop the ball? I mean, they made this horrible argument about no gift because the surviving spouse created those trusts. They made that horrible argument. Did they just not know what they were doing when they did that, and they didn't think about this argument? Or did they make this argument here, and the CCA just ignored it? I would tend to think that they probably, did a good job and omitted that argument, and the CCA just omitted the argument because the IRS just didn't want to, publicly mention that argument or deal with it. But I don't really know. But it does concern me that we do modifications of trust all the time, and I will take the position that a remainder men didn't make a gift because there's no assurance the power of appointment would be exercised in their favor. This kind of puts us on notice that the IRS would argue that there's a gift. Now, whether the IRS will win or not, again, the CCA, that is just an assertion by the IRS National Office on how to conduct this audit. It's not like it's an official position. It's not like it binds anybody in particular. And they very well might, if they litigate this case, the IRS might very well lose that. So I'm not saying that there's law on this or this is some kind of adverse precedent. But I am saying that it's putting us on notice that this argument that we frequently use, that the remainder men are not making a gift when they don't object to certain things that occur because the remainder men are simply takers in default of a power of appointment, the IRS may very well disagree with that. And you may very well want to advise the remainder men now, in light of this CCA, that they should be filing gift tax returns, do the full disclosure, claim that zero gift. They're not all that likely for the IRS to come back and audit it. In this particular case, when you have this marital trust and the surviving spouse dies, if there's an estate tax return that's required to be filed, they're going to say, what happened to the marital trust? And then they will scrutinize it, and then, and then everything is right in front of an examiner's nose. And the IRS does examine most estate tax returns that have tax due. So this could very well get a ton of scrutiny. Whereas if you do a gift tax return now with adequate disclosure, then the IRS might not take a look at it, might not pick it up, and you may get your statute of limitations to run. So consider advising the remainderment to file those gift tax returns. But please don't argue that the remainderment essentially created irrevocable trust for themselves. I definitely don't want to undo that careful planning. All right, now we are on to our next poll. Today's second secret word is state, which I really enjoyed because we just expanded into New York, so we have another state added to our list of offices, which is why we're doing New York and New Jersey credit for this webinar. So today's secret word is state. So please go ahead and answer the poll. All right. Now let's go on to this next topic about separate shares to avoid distribution on the primary beneficiary's death. So what about keeping the trust together? I think that is still kind of a heavy lift. So think about it. You have the separate shares. Each remainderman has a different goal. Each per beneficiary. Each beneficiary may have a different idea on what's appropriate to invest. They may have different needs. And of course, their different needs inform the investment strategy. Somebody who doesn't have needs for a long term can invest things in totally long-term assets, and may be more willing to invest, more in stocks. Somebody who has really short-term needs may need things that are pretty liquid, may wind up having, treasury bills or something so they can tide them over and get those distributions. So if you're going to create separate accounts, and you have maybe different money managers, different accounts, you do different distributions, you're separately accounting for everything. That's what would be needed for those separate shares. And the trustee is going to want to be protected from liability. So you're going to want to do some kind of a non-judicial settlement agreement before creating these separate shares and taking the trustees off the hook from one beneficiary suing over what's going on in another beneficiary's separate share. So if you go to all of that, the IRS might just say, hey, if there was a termination that was required and you're just doing these separate shares instead, you have an unduly prolonged administration and the trust has been deemed to have terminated. Now, if you don't do that, then the government might just put regulations that say, if they do this new tax on distributions, tax on deemed distributions from the trust, or actually, I'm sorry, if the trust makes a distribution and you have a tax on it, they may say, hey, we want to avoid people prolonging the administration so they can defer paying this tax. So they may do regulations that will say we're going to treat separate shares as separate trusts for purposes of this tax on termination. The other concern I have about this is if it's not separate shares from inception, you may need to have it authorized in your trust agreement. So take a look at that regulation I cited in that first bullet point. The other thing is that if you're doing taking the position, this is all one trust. We haven't made our distribution. So then all three shares are mushed together for purposes of the income tax return. And if one share has a loss, there's some knotty issues that might arise. And I had the regulations cited in that second bullet point, and you can look at my discussion in the material. All right. So now I'm going to move on from this idea of separate versus combined trust and the termination and all that kind of stuff. And I just want to focus on just the change in rates. So the Biden plan would tax capital gains at ordinary income rates if you're in the top bracket. And for individuals, we know that's going to be at least $400,000 because that's what Biden was saying is what he considers to be high income earners. But $1 million, I think, is more what he was tending to say in terms of your capital gain rates. But a trust reaches the top bracket after only about $13,000 of taxable income. And I don't think that he would say, oh, well, we're going to look at trusts as being poor as well or being middle class as well. He's going to say, no, trusts are a rich man's tool, and we're going to nail those trusts when they get the taxable income at the highest rate. So my question is, what are we going to do if we have capital gains taxed at ordinary income rates? Portfolio turnover is a problem. People do have tax managed accounts, and the tax on the capital gains is a drag. And now we've got the tax on capital gains that might be almost doubled. Do you want to spend a little bit more time maybe on planning out your capital gain strategy? Now, of course, one thing is that if you're making distributions to the beneficiaries anyway, we can carry those capital gains out to the beneficiaries. And you see at the top of that slide, I have a reference to 2J8, and that really is the idea that there's a lot of ways to get capital gains out to beneficiaries. I have a webinar that I offer through CPA Academy on how to get income tax at beneficiaries' rates. So that can take quite a while to kind of go through that. But that is one thing you can do. And then in that second bullet point, that reference to 2J3A, that is just kind of assuming the beneficiaries have lower rates, but do they really? So what are the factors to think about when you look at that? So other than distributing the capital gains out to beneficiaries, how might you avoid the tax on turnover? So one thing that individuals have come across for many years is that people might recommend annuities and say, hey, you get a tax-deferred annuity. You're not annuitizing it yet. You're not paying it out yet. You're just accumulating it over the years, and that'll avoid the tax on the turnover. So you can have all that turnover for many, many years. Don't have your return dragged down by it, and then later on you can take out the annuity. So all distributions are subject to income tax, but it could be that avoiding that drag every year gives you so much more money that it's worth having to pay those higher rates. So that's a particular thing that individuals have thought about. What about having grantor trust, non-grantor trust? What do how do those annuities held by those get taxed? And there's a letter ruling that got issued in 2020 that described the IRS's view of non-grantor and grantor trusts when they own annuities. So I'm going to talk about annuities for just a moment, and then I'm going to talk about life insurance, because life insurance, you have variable life, that also avoids income tax, and it's life insurance is a much more income tax favorable than annuities. but there's some estate tax issues that go along with that. Okay, so trust holding annuities on slide 37. The code says that you have to be a natural person to hold an annuity. So a trust would not seem to qualify as a natural person or an agent for a natural person. But the legislative history has indicated being pretty liberal about this, and there's lots of private letter rulings that basically say if you have a trust for a beneficiary, you're going to be okay. You don't have to worry about that rule. So you can see here I do kind of go through provisions in my materials. I'm not going to go through all those in detail. Taxation of distributions under annuity contract, and a penalty for early distributions, and also required distributions when somebody dies. On slide 38, you see my other provisions here where I go through what that letter ruling says on an annuity contract issued to a grantor trust or a non-grantor trust. And I also have provisions on loss of sale annuity or comparing the annuity to life insurance. And again, you can read those, but I'm going to give you kind of a high-level view right here. So on slide 39, an annuity contract's investment return is non-taxable to the extent it stays inside the annuity. In most cases, when the annuities contract is making its distribution, 100% of the distribution is taxable until all of the investment return has been distributed. Now, many, many, many years ago, you used to be able to kind of prorate your basis when you take things out. And then there was a tax law change to say, nope, it's income first. And that does get me concerned about, like, are they going to pull the same trick with Roth IRAs down the road? That's kind of a sidelight, but it does show Congress does do revenue grabs by changing the rules out from under us. So a nice thing about an annuity is it can be rolled over free from income tax into another annuity contract with the same annuitant, or to a qualified long-term care insurance contract for a person. So if you have an annuity, it's built up all this value over all these years, and you have these long-term care needs, and you want to pull the money out. Well, roll it over into the long-term care contract, and then have it come out tax-free, and you maybe you're not going to have to pay any income tax on any of the annuities earnings. Now, distributions are generally subject to a 10% penalty if you do it before age 59 and a half, and that letter ruling says, well, a trust doesn't have an age as a natural person. So basically, when you take it out during the annuitant's life, then you're going to have a 10% penalty. So it's an unfavorable ruling from that viewpoint. Now, if you have the sole current beneficiary to the trust and they die, distributions after their death are not subject to the penalty because that's an early distribution penalty, and it's not early because the annuitant is dead. What happens if you have a trust for multiple beneficiaries? We're not really quite sure how that would work under that letter ruling. Another problem with annuities is that there's no basis step up at the beneficiary's death. And also the annuity distribution period. So when you look at the code, at the Internal Revenue Code, about the rules for distributions after somebody dies, they have a rollover for surviving spouse. But the rules that they have are very, very similar. The statute for annuities is very similar to the statute for IRAs. And you would think that, well, do the IRA minimum distribution rules, do those exceptions apply? Like if you pay an annuity to a trust, then does that let you roll it over? Like not roll it over, but take an inherited trust. So you have an inherited IRA in a trust. If you have a so-called see-through trust, then you can use the beneficiary's life expectancy. Of course, that's changed with the Secure Act, and for most beneficiaries, you can't do that anymore. But you do have this language that's the same under the annuity statute as it is under the required minimum distribution statute for IRAs. And we have regulations that say for IRAs, yes, if it's a trust, you can use that beneficiary's life expectancy, again, limited heavily by the Secure Act. But what about annuities? It has the same language, and there are no regulations under that. And insurance company back offices say, hey, there's no regulations. We're going to take a strict interpretation. The trust is not an individual. You don't get to get an individual's life expectancy. You have to distribute it within 5 years. And you don't get the 10-year spread of the Secure Act for IRAs. It's a 5-year thing. Okay, so this ordinary income taxation, the 10% penalty, and lack of basis step-up make an annuity unattractive. And the tax deferral can be powerful, so that may make you want to get an annuity. Also, if you build up the annuity and then you just take it out because the beneficiary needs that money for living expenses, so the annuity is making the distributions to the trust, and the trust is turning around and right away distributing those to the beneficiary. So you'll get this ordinary income, this tax at the beneficiary's rates, and the beneficiary might be in a low income tax bracket. So maybe we don't care that these reinvested, the annuity is reinvesting capital gains and getting them taxed at ordinary rates. Maybe we don't really care about that fact that we're losing the favorable capital gain taxation, because when it goes out to the beneficiary, if it's modest distributions and the beneficiary is in a low bracket, then you can get it taxed at a lower rate. So maybe the lack of capital gain taxation is not such a big deal after all. Again, this is a fact and circumstances thing. I'm not high on annuities. I just want to recognize there's a proper place for them at different times. Now, life insurance is much more favorable from an income tax viewpoint. When a variable life insurance contract, for example, I mean, that's the only place you're really going to be getting these stock market returns. Again, my point about the annuity was you have portfolio turnover, which is basically when you're investing in stocks and the stocks get traded because you're wanting to maintain your diversification of your portfolio. So the only way you're really going to be investing in stocks is really going to be, in terms of life insurance, is going to be through a variable life insurance contract. And you can take distributions from the policy, and they're not going to be taxable to the extent of premiums paid. Unlike an annuity, where every dime is taxable until you've recovered all the investment income. So life insurance is very favorable. You can borrow out as well. That benefit is free from income tax, so that's like getting a basis step-up, whereas annuities don't get a basis step-up. And a life insurance policy may be rolled over just like an annuity contract to an annuity with the annuity being the insured, or to a qualified long-term care contract. But a life insurance policy can also be rolled over into another life insurance agreement. Okay. Oh, the next slide is a little bit out of order. I'm going to talk about estate tax issues with it, and that we should consider having a life insurance partnership. I'm going to do that on another slide. Now I'm going to go to the final poll. Today's third secret word is ship. So in fact, we have our New York and LA offices, so we have harbors there. So I mean, St. Louis also, St. Louis and Chicago have some water activity as well, especially St. Louis having a big barge industry. But I really like our new office having harbors there. So ship is our secret word. Okay, so estate taxation of insurance on the beneficiary's life. Now, estate taxation is unfavorable, and there's a revenue ruling and some cases and letter rulings And you'd think, look, let's suppose we have a trust owns a policy, it's on the beneficiary's life, the trustee makes the decisions, the trustee has all the access to the cash values. Yes, they can only be done for benefit of the beneficiaries, but the trustee is the one who has absolute control over the policy, all the features of the policy, any distributions from the policy. So the trustee has all instances of ownership. So you would think that if the trustee has all instances of ownership, no issue about the beneficiary having estate taxation. But the answer is that the position has been taken that if a beneficiary has any way to compel a trustee to make a distribution, that beneficiary may have instance of ownership. So particularly if you have income being diverted from the trust to pay the premiums. So it's not only just the issue about whether the trustee might be forced to make a distribution to the beneficiary, but also could the beneficiary object to the trustee making payments of premiums? And the IRS might assert these issues. Now, if the trustee has absolute discretion about distribution of income and principal, so no ascertainable standards just for welfare or best interest or whatever, and the discretion to pay the premiums, and absolute discretion about whether to make distributions, you may be okay. But I just view this as an area of uncertainty. I don't really agree with a lot of what I'm reading from the IRS, but we don't want to fight. So consider a life insurance partnership instead. So the partnership interest is opaque if the partnership receives the death benefit. So as long as the policy is payable to the partnership, the policy, there's no instance of ownership attributed to its partners. So if the trust enters into a partnership that holds the policy, and the partnership is the beneficiary of the policy, and the partnership receives any distributions, then you kind of cut it off. For estate tax purposes, all the trust has is a partnership interest. It doesn't have a life insurance policy, and so we wouldn't have to worry about that. So if you are going to go toward variable life for this, instead of thinking about all the IRS's arguments that I mentioned on the prior slide and whether or not they have merit, and you just want to try to avoid that fight, consider forming a partnership between the trust and I don't know who else. Maybe you have multiple trusts, an exempt and non-exempt for that beneficiary. That might do the trick. Maybe you have somebody else who's a partner in there for a small portion. Two caveats on this. The partnership should obtain the insured's consent to the life insurance policy. That's the second bullet point. There's a one-page notice and consent that I have in my materials that you can use. Also, if the partnership transfers the policy to somebody else, then like it maybe makes a distribution. There's something called the transfer for value rule that may cause the death benefit to be taxable at some point. So you want to be aware of that. So those are those caveats. But I really do enjoy life insurance partnerships, and I really a life insurance LLC is what I use to fund business cross purchases, and it can be just very valuable. I want to let you know of other resources, and then I'm going to go into some questions and answers. So for people who are CPAs and they want to get the CPE, they can get free CPE through my CPA Academy webinar page. You have a sample there of some of the things, but that's available to anybody for free. And if you don't need CPE and you just want to get some education from it, you can click there and then you can listen to on-demand recordings at any time. I have a blog which also points you to former, if you click on that blog, you'll see there on the left something that has a link to all prior TCLEs I've done. So that's helpful. You can see I have reports on Heckerling. There's a link to get my newsletter if you don't already have it. October 26th is going to be my webinar for my third quarter newsletter. And there's also another link to free Thompson-Coburn resources so that other practice areas have for anybody who is interested in some additional free legal resources. So now I'm going to go into some more questions. So some of this was, in terms of the separate trusts, when I was talking about dividing it into the separate shares. What if you got a a court order instead of a non-judicial settlement agreement? So I'm not really too excited over the order by the court in lieu of the non-judicial settlement agreement. I mean, some states might require, depending on the subject matter, that you do get a court order if you want to do something like that. Missouri does have, for example, Missouri, if you're going to change the beneficial interest, then you have to have a court order. But a lot of times the court order simply helps you figure out who your beneficiaries are and make sure they're bound by it. And you may or may not need that. I had a question going back to the termination of the marital trust. And so the question is, if the surviving spouse assigned her income interest to the kids, would that work to avoid income tax on the termination? And certainly the spouse could make a gift. And when you make now, first of all, it's really weird how you draft marital trust. So the code provisions that govern this, 2056 and 2523, say that your marital deduction trust cannot allow any distributions during the spouse's life to anybody else. And yet we have Code Section 2519 that says, what if the spouse assigns her interest? And those kind of contradict each other. And the way that I handle it in my drafting is I never expressly authorize the spouse to assign the interest, but I do say that the spouse, I do say that the dispensative clause where it says that a beneficiary can't assign their interest, I do put in there that this does not prevent the beneficiary from renouncing their interest. So the surviving spouse could renounce their surviving spouse's interest in the trust, and then the question is where the income goes and what happens under state law, whether that accelerates the remainderment or not. But if the surviving spouse doesn't assign their interest, you have gift tax consequences going the other way because the surviving spouse is deemed to have given up the entire trust. So 2519, I don't really view it as a great solution here, but I just wanted to address that particular question. Another question in a revocable trust, if one spouse dies, will that trigger the capital gains treatment? Yeah, according to Biden's proposal, death is an event that will trigger capital gain treatment. And in fact, there's two bites the IRS gets. One of the bites is when they die, there's a deemed gain. And then when the trust terminates, there's another distribution occurring then. So if you've had assets that have grown during postmortem administration, then you may have a second bite there. I am going to do some more questions after this, but I want to do my concluding remarks. So those who want to sign off can sign off. Thank you for participating in the webinar. Please complete and submit the survey that we'll display at the conclusion of the webinar. I had another question that asked me when I was talking about C corporation stock and if you can sell it and not be taxed on it. And they asked, was I thinking about Code Section 1202, qualified small business stock? And the answer is yes. And I do have a lot of materials on that in my big PDF, and that really is available only if the sun, moon, and stars align properly. So I don't count on getting that treatment, but if you do have a C corp, there are things you can try to do to maximize your chances of doing that. Another question was, how do you determine the amount you reinvest each year back into the company? Is it based on industry or percentage or other rules? And really this is just what are the business needs and what are the business plans. So that's what I go by. Okay. I did have some questions about the Van Hollen bill being a trial balloon to help net worth people from early planning, and I'm not going to make any political comments about it. I did do a webinar that's available on the CPA Academy with Marty Schenkman and Joy Matak, where they talked about the provisions of those bills. So if you want to know more about those, you can go to that webinar. How do you get the big PDF document? Somebody asked. So the newsletter that's in your resource widget. In it is a button, a yellow button in the middle of it, and you just download. You click on the button and download from there. So I'm out of time. If anybody didn't get a question answered and you want it answered, just go ahead and send me an email, and I'll answer it in due course. Probably Friday night while I'm on a plane. It would be my best guess. Anyway, thank you very much. I appreciate this, and I look forward to the October 26th TCLE, as well as other contact we can have before then. Thank you, and have a great day.